All right, we've been watching Market Meltdown this week. John Jannarone, editor-in-chief at IPOEdge.com. I want to bring you back into the equation here. What do you make of today's market activity?
Well, Brad, as I was saying before, this has been a story not of individual stocks, but of baskets of stocks being sold. I will say, since we were talking about Beyond Meat, and that's the numbers that we have at our fingertips right now, is if you go through, they crushed it on virtually every single metric. And the stock was up a little bit after market, but it doesn't appear to be hanging in. And if you can't rally on numbers like these, the market is in trouble. This is a really bad sign. When you see a company completely destroy its quarter and give guidance it's way higher than was expected, these guys could not really have done much better. The only missing piece perhaps was the McDonald's announcement that people were looking for, but this is something to be scared about. And, you know, I think that another thing to keep in mind here that we discussed a little bit briefly earlier is that this is really computer-driven trading. And I think that, you know, we've talked a lot about AI in the last few years, but we haven't seen it really working its magic, you know, on a day like this until now. So this is really something to see. I mean, I think that what you're having is computers picking up, scanning, you know, communications and news announcements very carefully, and we're seeing, you know, billions and billions of dollars of stocks being traded based on individual words that are being picked up. You know, all those traders standing on the floor behind you, trading these individual shares are not really what's driving this.
Yeah, and John, I mean, it seems like, you know, we had actually talked to a guest, I'm not sure if you were able to hear our interview from earlier, but he had brought up this idea there's a big delta right now between earnings and adjusted earnings, and that was also an indication of sort of the health of the underlying fundamentals. Have you looked into this at all?
Yeah, actually, I did hear him speak, and I think that's a really good point, Hope. I mean, sometimes you see things like that happen, and I believe that was true about 12 years ago. We were heading into the financial crisis. It's a bad sign. You see things, you know, you see investors giving companies more and more leeway. Although I would point out, since we cover so much in the IPO world at IPO Edge here, that IPO investors have actually started to be very, very tough on companies in that regard. But yeah, what he was pointing out was that, yes, across the board, there has been a much, much broader acceptance of adjusted measurements. And, you know, when you see that happening, it means that, you know, financial analysis could be getting sloppy.
What do you expect for what remains in this earnings season? I mean, we still have some big companies that are going to be reporting, especially on the retail side. So what are you expecting to hear from them when they have to address consumer sentiment, consumer confidence amidst the wave of new headlines around the coronavirus?
Well, my guess is that if they're being strategic about it, these CEOs are going to take the bull by the horns and be conservative. So I would expect a lot of pretty negative news in that regard in the next few days, Brad. I mean, they would much rather, if they're smart, have it get out there right now than come by surprise when they're not ready for it. So I would anticipate a lot of executives addressing the real possibility that consumers are going to be less likely to leave their homes and that sort of thing. I mean, you're seeing it a little bit at a time here with, let's just say, Disney, for example. You know, they've closed some parks over in Asia. I was just reading that down in Florida, they are not allowing workers and actors at the parks who had been traveling in Italy and some other places to show up there. So I think that they're going to get out ahead of this and say these are real risks that are a part of it, so that you know, they can be as transparent as possible with investors. So I would expect to hear a lot of brutal honesty and conservatism.
John, this really feels so significant and so different than any other really big factor that we've seen. I mean, China trade, these are human-driven decisions and chaos situations. This completely out of our control at this point. And if you look down the line, right, at just how companies are going to change, I mean, let's just start with the fact that if investors are not interested in looking for returns in these markets, like where else are they looking? Thinking about the IPOs that we had been eagerly awaiting, I mean, none of that at this point even seems significant in the face of this.
No, you're right. I mean, we were going to talk about DoorDash, which, you know, filed confidentially today, but I think we can all agree there's no way in heck that deal is coming anytime soon, right? I mean, I think that the financial markets are going to slow down, and I mean, I hope not, but they could we could see some drying up. This really does feel a bit like what we saw 12 years ago. And I was actually talking to someone who looks at a lot of fixed income and hybrid securities, and those are starting to pull back too, the hybrids. So I'm talking about some of these bank preferreds, which look like they're very, very safe. So I think what you're seeing is a lot of money just being put straight into cash. I mean, it surprised me this morning when I saw the market getting hit so hard. I talked to two managers who, combined have a few $billions in assets, and they're net short the market. I don't think that most investors should be playing around with that, but I think a lot of investors who have a long-only approach are building up cash positions.
Right, and I think that is sort of the concern. I mean, we are here trying to also educate those that are watching, don't panic. Every investor, every analyst we've talked to this last week is don't panic. But I mean, at this point, you're watching this, you can't help but feel a little afraid right now, thinking about people going into cash. I mean, that's even then more of a pullback. And retail investors already went crazy on Monday to the extent that you had seen Fidelity, E-Trade. I mean, their platforms had issues because of this high volume. And now that we may have kind of set off a trigger now for maybe retail investors, I mean, what do the next couple of months look like? What does life look like, on a day-to-day basis when the financial markets are driving so much of the funding, right? I mean, companies go public because they want to see growth and get funding, crowdfunding through the public markets. Now that this is shrinking, maybe even a little bit, what does that look like maybe on a day-to-day basis?
Yeah, well, I hope you're totally right. I mean, remember that the stock market affects consumer sentiment in a big way. So, people who don't normally pay attention to this like we do and follow its every move are going to notice what happened this week. These numbers are unbelievable. I mean, what are we down? 12% for the week or something? This is going to get noticed, and it's going to scare people. People who have retirement accounts are going to look at them, and they're going to be less inclined to spend money. So there can be a very vicious cycle. One thing I would say is that it would be a grave mistake to try to time this if you're a retail investor or you're trying to look at your retirement account and say, okay, I'm going to make a very quick, significant move in my stock versus cash position or something like that and try to time it. I mean, what you really need to do, depending on your time horizon, is remember that markets do move up and down, but in the long run, when I was first starting out and I was working as an index fund trader, my boss had a chart on the wall, and it showed the stock market since 1920. And in the long run, it was a very straight line. It's bumpy sometimes along the way, but it went from low to high. So, these kinds of things do happen, but I would encourage people to avoid panic and remember that this is just part of the game.
Yeah, just to clarify, one of our lowers as well, single biggest point drop in history that we're seeing here, because the percentage versus the point drop, of course, the percentage is what we should also keeping a close eye on here as well. Some of the percentage drops that we saw in 2008 coming in at nearly 7%, the Dow here closing down by 4% off of that, but still a significant point drop, the deepest in history. Just quickly, John, as well, my question more so around the action that you think the Fed is going to take. Does this push up their timeline to actually have to react?
I'm glad you brought that up, Brad, because I was having that conversation with both of these hedge fund managers. So I've been on the phone with most of the day today. That is their real worry, having gone short. It's pretty rare, frankly, in a market like this, it feels bullish for these guys who manage billions of dollars to flip from long to short. And that is the main thing that they're concerned about. I think that the market had baked in a rate cut perhaps in April or May.
March, actually, now. Our CME Fed Watch tool has March.
Okay, gotcha. All right. But I mean, it could happen very, very soon. And remember that we live in an extraordinary world where President Trump is not afraid to push or even bully Jerome Powell. So I would not be shocked if Trump's on TV tomorrow morning demanding that we get a rate cut.
Right. I mean, but how much would that really change things, right, John? If we talked about, again, the fundamentals here, maybe not being as healthy as we had previously anticipated, that this has been a dressing up of the companies, especially when it comes to earnings on the adjusted versus the non-adjusted basis. And then we look at it and, just how much the markets has been overvalued because there's been nowhere else for people who have a lot of money to invest, to put their money, and that's why they've been here, fixed income aside. And you just even raised that point, right? I mean, fixed income options are even now sort of off the table inevitable at this point. People are going into cash. Treasury yields, falling, 30-year falling. These preferreds, they're falling. So at this point, even if the Fed, takes a drastic measure, how much is that really going to help the situation? Is it going to do anything?
Well, I mean, this just brings me back to, early 2009. I remember when this was happening, you had the Fed doing more and more, but eventually in March 2009, it worked, right? The market bottomed out, never really looked back. So I think that the Fed can be incredibly powerful, but you're right. It's also potentially very dangerous. There's a risk of inflation. We managed somehow to survive that, but last time around, but who knows? I mean, so the managers I've been talking to this afternoon have, they've been going into treasuries, long in the dollar and gold. So that would be, that's sort of their hedge against this possibility of, a massive injection from the Fed, which I think, based on this, looks incredibly likely now.
All right, John, we certainly appreciate the time and the extended grace that you've given to us with your time, breaking down all things the markets and this historic day that we've been watching here. John Jannarone, editor-in-chief of IPOEdge.com, good friend of the show. Thanks so much, John.
Thank you, John.
Thank you, guys.